Greetings, everyone, and welcome. You're tuned in for a focused exploration brought to you by Accumulation Pro.
Hello there.
Today, we're diving into something that might seem pretty basic on the surface, but honestly, it's often what separates traders who find real, consistent success from those who struggle.
That's right. We're talking about keeping a trading journal.
Exactly. And we want to dig deep into this.
Yeah, because it's really not just about, ticking boxes and writing down trades. It's much deeper. It's about self-awareness.
And strategy development, right?
Absolutely. It's like building your personal roadmap for navigating these, let's face it, complex markets. One trade, one observation at a time.
It really helps cultivate a deep understanding, not just of the market, but of yourself, how you react to the market's moves.
Which is critical.
It really is.
Yeah.
In such an unpredictable environment, having that internal compass, that sort of consistent reference point, it's invaluable. It's actually something we stress heavily in the data-driven methods we use at Accumulation Pro. The importance of staying grounded, especially when things get volatile.
Think of it as your own personal after-action review for every single trading decision you make.
Okay.
Every entry, every note you jot down, even the emotions you record. It all becomes valuable data.
Data you can use.
Precisely. And when you take the time to look at it all together, you start seeing these powerful insights. What's working, where you might be tripping up.
How your strategies are actually performing in different conditions.
Exactly. It moves beyond guesswork.
Now look, we're just getting started here, but if you're already finding this kind of detailed look useful, and if you think other traders could benefit from this knowledge,
we'd really appreciate it.
Yeah, please take just a moment to, like this content, share it with others, and subscribe if you haven't already. It really helps us reach more people.
Helps get this information out there.
It does. Your support makes a big difference in helping us empower more traders. Okay, so let's get specific. What exactly are we talking about? A trading journal.
Right. So at its core, it's a really meticulous, ongoing record of every single trading decision you make.
Every single one.
Every single one. And like we said, it's not just a logbook, it's documentation of your whole thought process.
The why behind the trade.
The why, the market conditions at the time, your emotional state, the strategy, and then of course the outcome.
And this record becomes a resource, right?
Mm-hmm.
For analysis, for learning.
For continuous improvement. It's dynamic.
It's about capturing the whole story, isn't it? Not just the numbers, but the context, the reasoning.
And how you felt. That emotional piece is huge. It gives you that holistic view.
Okay, so what are the absolute must-haves? The essential components?
Well, first, the basics.
Yeah.
The trade details. You absolutely need the date and the time when you got in, when you got out.
Precision matters there.
It does. Then, the instrument. What were you actually trading? Was it Apple stock? Was it the euro-dollar pair and Forex, maybe oil futures?
Got it. Be specific.
Very specific.
Yeah.
Then your entry price, your exit price, naturally. How big was your position? Position sizing is crucial. And then the bottom line, the profit or the loss from that specific trade.
Right, the P&L.
Yeah.
But you mentioned it goes beyond just the numbers.
Oh, definitely. The strategic rationale is incredibly important. Why did you take this trade in the first place?
What was the trigger?
Exactly. What setup did you see? What specific rules or conditions from your strategy were met? And just noting which strategy you were even using.
Because you might use different ones.
You might. So noting that down provides vital context when you look back later.
Okay, and you mentioned emotions. That sounds potentially difficult to capture accurately.
It can be, but it's arguably one of the most insightful parts. How were you feeling before you clicked the button?
Like confident, anxious, maybe impulsive?
All of those. Or fear of missing out, FOMO is a big one. And then what about during the trade? As the price is moving against you or for you?
Stressful or exciting?
Right. Note it down. And then afterwards too, win or lose, how did you feel immediately after closing out?
And the goal there is pattern recognition.
Absolutely. Seeing recurring emotional responses, like maybe you always get nervous holding winners or you get reckless after a loss, identifying those patterns is the first step to managing them.
Makes sense. What is
the market context? You can't analyze a trade in a vacuum. What was the broader environment like?
Okay, like volume. Was it high, low?
Yeah, volume trends. Was the market generally volatile or quiet? Were there major support or resistance levels nearby that influenced your decision?
So connecting your trade to the bigger picture.
Exactly. Understanding that context often explains why a trade played out the way it did.
So lots to record. What about the format? Does it matter if it's pen and paper versus, say, software?
The most important thing is finding something you'll actually stick with. Consistency and detail are paramount.
So personal preference plays a role.
Totally. Some people love the feel of a physical notebook. Others prefer a spreadsheet like Excel for organization.
And there's specialized software now too, right?
There is, yeah. Trading journal software or web apps are increasingly popular. They often have cool features like built-in analytics, charting integrations, reporting that can really streamline the review process.
Which ties back to that data-driven approach we talked about.
Precisely. At Accumulation Pro, we really believe in that. Our algorithms rely on meticulous data analysis.
And your journal is your data.
It's your personal trading database. Maintaining it diligently gives you that solid, evidence-based foundation to evaluate and refine what you're doing.
Okay, let's talk about specific trading styles.
Yeah.
Does this apply equally to, say, day traders versus someone holding positions for weeks?
Well, it's valuable for everyone, but I'd argue it's perhaps even more critical for swing and positional traders.
Why is that? Because they're holding longer.
Exactly. When you're holding for days, weeks, maybe longer, you're inevitably going to ride out bigger market swings.
More time for doubt to creep in.
Definitely. And more sustained psychological pressure as the trade unfolds. Discipline becomes absolutely essential to stick to your plan during those longer holds.
So the journal acts as a sort of anchor.
That's a perfect word for it. An anchor against the temptation to make impulsive moves based on short-term noise that doesn't actually invalidate your original reason for entering the trade.
Resisting that urge to just do something when the market gets choppy.
Right. It keeps you focused on your initial analysis and objectives. This is really important, especially for retail traders who maybe sometimes react more emotionally.
Compared to, say, institutional smart money.
Often, yes. They tend to have more systematic objective processes. The journal helps the individual trader build that kind of discipline.
So it's fair to say a trading journal isn't just a nice to have. It's really a game changer.
I firmly believe so. It empowers you to trade smarter, not just harder or more often.
Let's break down those benefits.
Yeah.
You mentioned performance tracking.
Yeah, that's a big one. Your journal becomes your performance dashboard. By tracking every trade, you move beyond just feeling like you're doing well or poorly.
You get objective data.
Objective data. Which strategies are consistently making money? Which ones are maybe lagging or even consistently losing?
And that lets you focus your capital and effort where it counts.
Precisely. Double down on what works, fix or ditch what doesn't.
Okay, and then the emotional mastery piece. We touched on this, but it seems crucial.
It is absolutely vital. Trading isn't just about charts and numbers. Our psychology plays a massive role. Fear, greed, overconfidence.
They can wreck even the best plans.
They absolutely can. The journal forces you to confront these emotions because you have to write them down.
Just the act of acknowledging them.
Exactly. Okay, I felt really greedy on that trade and held too long, or I was scared and got out too early. You start seeing your own pattern.
Your triggers.
Your triggers. Maybe you get overconfident after 3 wins in a row and take a stupid risk. Recognizing that is the first step to developing strategies to stay calm and rational, even under pressure.
What about strategy refinement? How does the journal help there?
Every trade becomes a learning opportunity, win or lose. When you review your journal, you can pinpoint what's working and what's not within your strategy.
Specific elements.
Yeah, like maybe you notice your stop losses are constantly getting hit just before the market turns in your favor.
Suggesting they're too tight.
Potentially, yeah. Or maybe you see a pattern of overtrading in choppy markets, leading to lots of small losses.
Emission costs add up too.
They do. So analyzing this lets you make those data-driven tweaks. Sharpening your edge, adapting to changing markets, that's key.
And accountability. That seems like a big psychological benefit.
Huge. Knowing you have to write down why you took a trade makes you think twice before jumping in impulsively based on, some gut feeling or market noise.
It forces you to justify it to yourself, essentially.
It does. It fosters adherence to your actual trading plan. This commitment, this accountability is often what separates consistently profitable traders from those who are more erratic.
Having to articulate the why acts as a filter.
A powerful filter against bad decisions.
And finally, learning from mistakes. Turning losses into lessons.
This might be the most transformative aspect. Instead of just being frustrated by a loss, the journal gives you the data to dissect it. What actually went wrong?
Was the setup flawed? Was my timing off?
Or did I let emotion take over? Did I break my own rules? By analyzing losses objectively, you extract actionable insights.
So you don't keep making the same mistakes.
Exactly. Losses become stepping stones, not just setbacks. They're tuition paid to the market, but you get to keep the lesson if you journal properly.
Okay, this all makes a lot of sense. But to really leverage the journal, we need metrics, right? Quantifiable measures.
Absolutely. Tracking key performance metrics or KPIs is essential. It moves analysis from subjective to objective.
So what are some key metrics we should be tracking?
Well, a really fundamental one is the profit factor.
Profit factor. Okay, what's that?
It's a simple ratio that gives you a quick snapshot of overall profitability. You just divide your total gross profit from winning trades by your total gross loss from losing trades over a certain period.
Gross profit divided by gross loss.
That's it. So let's say you made $10,000 in gross profits over a month.
Okay.
And you had $5,000 in gross losses. Your profit factor is $10,000 divided by $5,000, which equals 2.0.
Meaning for every dollar I lost, I made $2.
Exactly. A profit factor above 1 means you're profitable overall. Generally, anything above, say, 1.75 is considered pretty strong, indicating a potentially robust strategy.
It's a quick health check for the strategy.
A very useful one.
Right, what's next?
Expectancy. This one is really powerful because it tells you the average amount you can expect to win or lose per trade over the long run.
Average P&L per trade.
Essentially, yes.
Yeah.
But it considers both your win rate and the size of your average wins versus your average losses.
Oh, okay. So it's not just about how often you win.
Not at all. The formula looks like this. Probability of win, average win amount. Probability of loss, average loss amount.
Okay, let's do an example.
Sure. Say your strategy wins 50% of the time. So probability of win is 0.5. And your average winning trade is $200.
Right.
And you lose the other 50% of the time, probability 0.5, and your average losing trade is $100.
Okay, smaller losses.
Right, so expectancy equals 0.5 $200, 0.5 $100. That's $150, which equals $50.
So on average, I can expect to make $50 per trade with this strategy.
Over the long haul, yes. And a positive expectancy like that is critical. It means the strategy has a positive edge and should be profitable over time, even if the win rate isn't super high.
That's a key insight, isn't it? Because a lot of retail traders seem obsessed with win rate.
They really do. They want to win 80%, 90% of the time. But expectancy shows that a strategy winning, say, only 40% of the time could still be highly profitable if the average win is much larger than the average loss.
It's about the relationship between frequency and magnitude.
Exactly. You need to balance win rate with the risk-reward ratio of your trades. Positive expectancy is the goal.
Okay, profit factor, expectancy. What else is crucial?
Maximum drawdown, or MDD.
Drawdown, that sounds like losses.
It relates to losses, yes. Maximum drawdown measures the largest percentage drop your account value has experienced from a peak high down to a subsequent low point before recovering back to that peak.
The biggest hit the account took.
In percentage terms, yes. For example, if your account hits a peak of $100,000, then drops down to $80,000 before starting to climb back up.
That's a $20,000 drop.
Right. The maximum drawdown is $100,000, $80,000, $100,000, or just $20,000, or $100,000, or 20%.
Why is knowing that percentage so important?
It's a critical measure of risk. It shows you the worst-case historical performance of your strategy in terms of capital decline. Knowing this helps you set realistic risk tolerance levels.
And make sure you have enough capital to weather those storms.
Exactly. And also, importantly, the psychological fortitude. Can you handle seeing your account down 20%, or whatever the MDD is for your strategy, without panicking?
The emotional side again.
Always. A very high MDD might mean you're risking too much per trade, or your stops aren't tight enough, or maybe the strategy itself is just inherently very volatile.
And understanding your typical MDD helps you manage fear during pullbacks.
Tremendously. If you know your strategy historically has a 15% MDD, then seeing your account down 10% might still feel uncomfortable, but you know it's within the expected range. It stops you from making fear-based decisions, assuming the strategy itself isn't broken.
So you aim for a drawdown level that's both financially and emotionally manageable for you.
That's the key. You have to be able to stick with the plan during drawdowns.
Which brings us back to the journal. How does tracking these metrics in the journal help navigate drawdowns and losing streaks?
Well, the journal provides the historical context. It helps you differentiate between a normal expected drawdown for your strategy and a losing streak that might signal a real problem.
So you compare the current dip to past performance recorded in the journal.
Exactly. If your MDD is historically 15% and you're down 12%, it's likely just variance. But if you suddenly experience a 30% drawdown, something might have changed, either in the market or with your strategy execution.
And it helps assess if a losing streak is just bad luck or a strategy flaw.
Yes. If your expectancy and profit factor tracked over time in your journal are still solid and positive despite the recent losses, it strongly suggests the streak is likely temporary variance. The positive edge is still there, statistically.
But if those core metrics start degrading alongside the losing streak,
Then you need to investigate more deeply. Is the market regime different? Did I change how I'm trading? The journal gives you the data to ask those questions intelligently.
okay, another area that causes confusion is realized versus unrealized gains and losses. Can the journal help clarify that?
Definitely. Let's define them first. Realized P&L is locked in. You close the position, the profit or loss is final, it hits your account balance.
Like buying at $50, selling at $60, that $10 gain is realized.
Correct. Unrealized P&L, sometimes called paper profit or loss, is the value change in positions you still hold.
So if I bought at $50 and the price is now $40, I have a $10 unrealized loss.
Exactly. It's not a real loss yet because you haven't sold. It could still turn around or get worse.
And that unrealized part is where emotions get tricky.
Very tricky. Seeing those red numbers for open positions,
Yeah.
that unrealized loss, it can trigger fear, anxiety,
Leading to bad decisions, like selling too early just to stop the pain.
or the opposite, holding a loser way too long, hoping it comes back, refusing to realize the loss because it feels too final. It's an emotional trap.
So how does the journal help focus?
By emphasizing the tracking of realized P&L as the true measure of your strategy's performance over time, your journal logs the actual outcomes of completed trades. It grounds you.
Focus on what actually happened, not what might happen with open trades.
Right. It helps you stick to your exit rules based on your strategy, not based on the emotional discomfort of watching unrealized numbers fluctuate. It keeps you objective and focused on actual results.
Okay, so for someone listening who's maybe new to this or hasn't been consistent, how do they actually create a useful trading journal, step by step?
Good question. It's simpler than it might sound. First step, choose your format.
Notebook, spreadsheet, software, like we discussed.
Yep. Pick one you'll actually use consistently. For beginners, maybe starting with a simple spreadsheet or even a notebook is fine, but ideally, moving to a dedicated web app offers more power later on.
Okay, format chosen. What's next?
Record the key details for every trade. No exceptions. Date, time, instrument, entry, exit, position size, the strategy used.
All those core elements we listed earlier.
All of them. And critically, the outcome, profit or loss.
Then the emotional notes.
Yes, make it a habit. Before, during, after. Just a quick note. Felt confident, got anxious when it dipped, frustrated after loss. Spotting those patterns over time is gold.
And track the metrics.
Track the metrics regularly. Calculate your profit factor, your expectancy, monitor your maximum drawdown. Do it maybe weekly or monthly at first.
Reviewing is key, right? Not just recording.
Absolutely essential. Set aside time each week, maybe Sunday evening, to review the week's trades, analyze what happened, look for trends in your metrics and your emotional notes.
And make adjustments based on that review.
That's the goal. Identify what's working, what's not, and tweak your approach based on the actual data in your journal, not just random ideas.
Any final tips for setting it up?
One useful thing is tagging trades. Use keywords like earnings play, breakout, high volatility, impulse trade.
Why tag them?
It lets you filter and analyze performance later. How do I perform on breakout trades? Do I make mistakes during high volatility? It helps generate really specific, insightful reports, especially if you're using software.
That makes sense. It adds another layer of analysis.
It really does.
So, wrapping things up, here at Accumulation Pro, our whole philosophy really centers on discipline, on data, and that drive for continuous improvement.
They're the cornerstones of successful trading, we believe.
And it feels like the trading journal is the practical tool that unlocks all of those principles for the individual trader.
Exactly. It's the key to better performance, better emotional control, and smarter strategy refinement. It brings it all together.
And tracking those metrics,
Yeah.
profit factor, MDD, expectancy, that's about quantifying your edge, right? Avoiding those psychological traps.
Absolutely. It moves you from subjective hope to objective analysis. It helps you navigate things like unrealized losses or obsessing over win rates by keeping you grounded in what actually matters for long-term profitability.
Which, in a way, mirrors our own approach at Accumulation Pro, doesn't it?
Yeah.
Using data, price action, volume.
To find opportunities and manage risk systematically. It's the same data-driven mindset, whether algorithmic or discretionary, using a journal.
So if you, the listener, are looking to bring more of that structure, that data-driven edge to your own trading,
We definitely encourage you to check us out. Visit accumulationpro.com. You can learn more about our trading algorithms. They're designed to follow smart money principles with a heavy emphasis on risk management for long-term success.
accumulationpro.com. definitely worth exploring if you want to align your trading with a more disciplined, data-focused approach.
Absolutely.
And maybe just a final thought to leave everyone with.
Go for it.
Just reflect on this. How might be consistently, diligently tracking every single aspect of your trading? Your actions, your thoughts, your feelings, the outcomes. How might that fundamentally change your understanding, not just of the markets, but of yourself as a trader?
That's a powerful question to ponder. It really can be transformative.
It really can. Thanks for that deep dive today.
My pleasure. Always good to talk shop.